Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for the first edition of Market Recap in 2022. I'm not joined by Bruce Campbell today, my normal co-host. I am lucky to be joined by the wonderful Richard Carleton, the CEO of the Canadian Securities Exchange. Richard is a perfect fill-in for Bruce because Richard, I have to say, throughout the pandemic, every morning I wake up to your morning emails where you talk about what's going on in the economy and the big movers and shakers. So thank you so much for jumping in and joining me today. It worked out perfectly.
Yes, it did. Thanks, Anna. And of course, a pleasure to be here today. And of course, I'm glad to get the feedback from the morning emails. I don't get a lot, but it certainly makes me feel better when I get all that off my chest each day.
They're wonderful, especially the far sides. I love the daily far sides. Okay, listen, we haven't talked to our viewers in quite some time. We ended off on December 17th of 2021. It's now a year later, well, a few weeks later. And we're going to talk about what's been going on. There's been a lot going on in the market. You're going to break it down for us. We're going to talk about economy as a whole, what's happening in Canada and globally in the markets. It might make people a little bit nervous. You're going to tell us what's going on there. We're going to talk about the big move of the week, the big transaction between Microsoft and Activision. It is the largest acquisition of a gaming company ever. And it was a $70 billion deal. We're going to break down what happened there. And then, of course, we're going to get into some CSE issuer news. You have lots to tell us about the CSE, which makes it even more perfect that you're with us here for the first edition of 2022. So, Richard, let's start with what's going on kind of on a global scale with the economy these days. What are we seeing?
Well, of course, the word on everybody's lips is inflation. And whether you're in Canada, the United States, any one of the other developed economies around the world, almost as often as supply chain disruption, which of course I've seen or heard being offered as an excuse for all sorts of evil. But I think that we're certainly seeing and have continued to see over the last several weeks expectations solidifying in the market, and people beginning to make defensive moves in anticipation of central bankers in the Western and developed economies begin to increase interest rates, and probably sooner rather than later. And they're clear from the minutes of the most recent meeting of the Fed. They're predicting, I think, 3 rate increases over the course of 2022. The Bank of Canada, of course, has been talking for at least 5 years about potential for increased rates. And even this week in Germany, we saw the German bond market actually yield into positive territory for the first time in 30 months. Because they've been in the unique situation, well, not unique because there's a few other economies where this is the case, but when you buy a bond, you don't receive interest, you actually pay it. So as I say, strange times, obviously, in the markets. And I think, again, with the amount of government stimulus that's flown into the economy, primarily, of course, as a result of response to the pandemic, that the inflationary pressures will finally break the camel's back and force the central banks into increasing rates. Now, of course, the interesting conversation is, well, what does this mean for investors? Are there opportunities in the bond markets for the first time? Because it's been years since anybody has pitched a reasonable sounding strategy to me as a retail investor as to how to appropriately or properly invest in the bond markets. And with more volatility, perhaps there are opportunities for folks that are coming at this point. Although I have to say, increasingly, the debt markets really are very much professional, institutional-oriented market, and that from a retail perspective, you do tend to see more of the action now in the ETF space, which have debt instruments as a component of the portfolio. But there's no doubt that the benchmark rates rising will have a significant impact on, of course, the valuation for those debt portfolios. We're also seeing, of course, a significant impact on the valuation of the so-called high flyers, particularly in the United States, although Shopify certainly falls into that category, Canadian company. With those companies, of course, priced to perfection and probably beyond at this point, longer rates or higher rates in the longer term will certainly push some of those expectations even farther out, and should, on a rational basis, negatively impact the present day valuation of the shares. And I think it's fair to say that we've seen a lot of the selling pressure on the FANGs, on Tesla, and certainly on a bunch of other names like Peloton, of course, which has been in the news over the last couple of days, has been extensive over the last couple of weeks. So we see the Nasdaq, which of course was flying very, very high through the third and fourth quarters, in particular of 2021, trade down below today, I believe, of its 200-day moving average. It's certainly, if it's not below, it's certainly right on it. And that's a technical indicator that suggests that maybe there's some dip buying opportunities coming across the market. But there's an interesting approach here, because when people talk to me about the pressure on these tech companies, and I'm really talking here about the Facebook or metaverse, I guess we have to call them the Mangs now, not the Fangs. But metaverse, Apple, Amazon, Netflix, and Google, and then of course throw Tesla in for good measure. Those are awfully well managed companies in a lot of ways, and there are I think there's certainly a bearish case to be made for Tesla. The valuation, of course, is equivalent to all of the other car makers in the world combined, and it suggests that Tesla will be delivering orders of magnitude more vehicles in the coming years, which just doesn't seem to be the case. So, clearly there's a rational exuberance behind the valuation there, but it's an awfully good company. I don't know anybody who's ever purchased a Tesla who doesn't absolutely love it. And of course, it explains the reason they don't actually spend very much money at all on marketing. It's voice of the consumer that is actually their biggest selling feature. So, and similar, and again, I think it's fair to say that the valuation is unjustifiable on any kind of rational basis whatsoever. But Microsoft, like, tremendously spectacular company. The wealth created by those successive management teams now over the last several generations has been spectacular. Amazon, obviously, a company who pivoted wonderfully during the pandemic. And although Mr. Bezos doesn't have a great reputation as an employer, there's no doubt that their expertise in logistics and delivery and so on is something that will be a strength that's not going to go away anytime soon. Netflix obviously is being punished heavily today in the markets. They gave what the analysts call very soft forward guidance from their Q4 results. And, I think that's probably an indication that they're coming close to hitting a saturation point in terms of their customer base and potential customer growth. From here, the explosive growth days are probably over for them. And they will be continuing to compete with other providers of content who are getting themselves organized for their share of eyeballs as we move forward.
Richard,
yes.
Sorry to interrupt, but I think we're kind of seeing this trend. We saw a lot of it in 2021. Obviously we're all sitting at home and we're looking to get our content online. Peloton had a rough start to the year. There was a TV show that came out, and just like that, someone died after being on Peloton. That hurt their stock. They had a few more issues after that. And then of course they've stopped production. They could try and be creating a supply and demand thing. Who knows? Elon Musk can go to Twitter and change his share price. We're starting to see kind of this reaction in the market. Do you think this is depictive of the fact that perhaps the valuations of these stocks are bloated?
Undoubtedly. It's also, of course, an indication of how much money is sloshing around in the system. And And again, as we get further into the endemic phase of COVID, there will be less money sloshing around. With luck, that means a return to a little more diligence in terms of the valuations of particular companies. I mean, we haven't talked about it yet, but one of the most, I think, powerful indications of the insanity of 2021 were the valuation of some of the SPACs earlier last year, where you had them trading at significant multiples beyond the actual cash in the SPAC. Now, that's a very, very powerful vote in favor of the management team of that SPAC being more astute than the hundreds of private equity and venture capital folks who are out there looking for deals that will be accretive, obviously, to to the investors. And that's just not going to happen.
Well, and just to clarify what you're saying there about SPAC, just in case people don't know this. So a SPAC is essentially a blank check company. The company will raise, I think the minimum is 40 million, if I remember correctly. And it goes into this company, it goes public, and then the management team goes and seeks an asset to vend into the company. What you're talking about is the fact that the company was trading at valuations way higher than
the cash
just
on
the
hand.
actual cash in the bank account and nothing else. And that is very descriptive of what's going on in the markets, right?
Yeah, that's right. I mean, that was clearly crazy. Now, as I say, I mean, Bill Ackman is a very bright guy, and he certainly made a lot of money for folks who've invested alongside him and in Pershing Square. But as I say, given that everybody was looking for the same deal last year, valuations for private companies going public obviously went completely crazy. And now many of them, if not, well, many of those transactions are trading considerably lower than the price of the qualifying transaction. And some of the other companies that went public are trading considerably below the levels of their IPO. And again, as I say, this is just an indication that some of we're starting to see that the money ebbing in the public capital markets, which is healthy. A refocus, if you will, on the companies that are growing their businesses, are making money, are increasing their dividends, and engaging in the type of behavior that historically the public markets reward.
I was just going to say, Richard, we're on the same page. I was going to say, the optimist in me sees this as an opportunity that the bloated, valuated companies that are going to take a bit of a hit right now, it allows the real companies with real fundamentals that are doing the real work and creating value are going to have an opportunity, because they're going to, the smart money is going to leave kind of the ones that are overvalued, and they're going to go, they have amazing analysts, they have amazing teams who have the ability to do the due diligence and invest in the companies that deserve the investment, wouldn't you say?
Yeah, and there are an awful lot of sectors in the U.S. and Canadian economies that haven't got a lot of love over the last few years. I think everybody understands that a significant percentage, and in fact, all of the percentage of the gains of the S&P 500 over the last 7-8 years come from the 5 stocks, the FANGs. And everybody else has either been low single-digit growth or, in fact, negative. So that tells you that there are areas which have been overlooked, ignored, unloved. And of course, 2 that are particularly close to the Canadian viewpoint are the energy producers and the mining sector. Both have been under tremendous pressure over the last several years for a variety of reasons. And in fact, both have performed very well over the last several weeks. That said, the oil market's taking a bit of a beating today, and that's not it's not the case today. But the Canadian oil and gas sector has performed very well so far this year in 2022.
Well, there's lots taking a beating today and over the past few weeks. I'm sure we'll watch this play out. I'm not sure that we're necessarily entering complete mayhem, but it'll be interesting to watch. Okay, so let's talk about the big transaction that we saw this week. Everyone's talking about it. Microsoft put in a bid to acquire Activision deal in a $70 billion deal. This is 70, almost, I think it was 68 point something billion. Just to clarify, this is all cash. Typically, these mergers are structured where there is, part shares and part cash. But this one was all cash. So what this tells me, and tell me what you think about this, it tells me that Microsoft holds such high esteem in the valuation of their stock that they didn't want to part with any of it or dilute any of their current distribution and just pay cash for it. This is the biggest acquisition ever for a gaming company. And what they're saying is this is really Microsoft's ambition to be able to position themselves in the metaverse world. So what do you think of this?
Well, I've got a few thoughts. The first one, of course, is that Microsoft as a business generates a breathtaking amount of cash. So they have to, and as the screen shows here, the stock is generating less than 1% yield, which tells you that they are not dividending the cash out to the shareholders. They are reinvesting in existing businesses or doing acquisitions. And I don't think there's anybody that would argue that they haven't been, again, extraordinarily successful in that strategy. And it does, in fact, drive analysts crazy who think about the growth versus the value approach, because Microsoft, even though it's one of the largest companies in the world, still behaves like a growth company essentially. So in any event, I think they're obviously we've seen a couple of schools of thought on the acquisition. I mean, the first one is there are obvious advantages for Microsoft to be acquiring more content. The Xbox is obviously an important contributor, that whole ecosystem, to Microsoft's earnings and its anticipated growth for those particular sectors. And the other component, of course, which people have talked about, is they acquire an awful lot of the skills or more skills that will be necessary if companies are looking to create a presence in, whatever the heck the metaverse is. So a realistic world for my avatar to, talk about setting up stock exchanges in the metaverses or something like that.
Richard, did you just say whatever the heck the metaverse is?
Hey,
I feel the same way.
As you know, Anna, I discovered a couple of weeks ago that I'm to become a grandparent this year for the first time. So that
congratulations on that.
Thank you.
So one interesting.
And I will say, publicly a Facebook refuser. But that said, it's clear that there are going to be more products and services and customer engagement and a whole bunch of things that are done in a virtual setting. We know about this, over the last couple of years. And companies that provide a more real world experience presumably are going to have an advantage in that space.
So here's the interesting thing about this deal. And then I just want to mention what they're predicting to come from it. The interesting thing is Activision is obviously the owner of such games as Call of Duty and Candy Crush, probably the two biggest games, in the past, 10 years. I trying to imagine both of those games in the metaverse. In my household, we got an Oculus over Christmas, and Candy Crush and Oculus. What does that look like? It's terrifying. Call of Duty as well. But what they're saying is that what we're going to start to see, and this is maybe something if you're wanting to invest in this space, what they're saying is it's going to be like Netflix in the streaming world. You're going to start seeing companies acquire, smaller companies in the space so that they can get a participation in the metaverse. So I think this is a big one, but we're going to start seeing this as a trend this year of kind of these consolidation of companies that are acquiring the ability to participate in the metaverse. So you and I are going to have to go into the metaverse at some point this year, Richard. I'll meet you there. We'll chat.
Well, I'll be a look younger, and I'll be a lot taller than I am in the real world.
I have a few changes as well. Okay, so let's move on from that one. We're going to talk about CSE stuff. That is, I mean, you're the perfect person to talk to us about this. We had a record-breaking year yet again. The efforts of the team. We have probably one of the coolest teams, I think, out there in the capital markets. And I know how hard you've worked, and our listings department, and everyone in the team has worked so hard for all this. I'm going to say a few of the stats here, and then I want you to just chat about some of the stuff going on. CSE issuers raised more than $8 billion in capital in over almost 1,200 financings, which is pretty incredible for a year where we couldn't go out there and pitch deals and people couldn't be on road trips. Is amazing that they were able to do that. We welcomed 182 new companies, which is just unbelievable. When I started with you guys 5 years ago, we only had 3 companies. We're now sitting at 743 companies with an aggregate market value as of December 31st of $49.3 billion. Mind-blowing, Richard. I mean, you've been here for a long time. You've seen this from the ground up, and it's pretty incredible where we're at. We're also working on some pretty exciting stuff. So now I'm going to pass this over to you to talk to us about what's going on with the CSE.
Yeah, we obviously have a great deal going on, Anna, and I have to say that I'm so glad to be heading up an organization that really has bound together through the pandemic to support each other, work to meet the demands that we've had. Because you're right, it's been extraordinarily busy for every one of our business segments. Folks that read the press release and the review of the year will note that by a significant margin, we had record trading volume. Well, that puts a lot of pressure on not just the technology, but of course on the folks that are supporting the technology and our market operations team. It also means that the folks that are covering the trading firms are also, again, out there working hard with the traders, any issues, and to make sure that everything's working smoothly. Market data, again, we've achieved, as we do every year, a new record level of customers and distribution of the data that's increasingly international at this point, which is good. And then obviously the headline story, as you mentioned, 182 new companies when we include the fundamental changes, means that our team, who in Vancouver and Toronto, who work with the companies when they first list, and then as they continue to list from a regulatory perspective, they've been meeting the customer service standards that we hold ourselves to, and having a lot of fun while we're doing it too. So it really was a tremendous year for the organization. And leading into 2022, what do we see? Well, we still have a very large pipeline of issuer companies that are looking to list on the company or on the exchange. So we've got, again, the trends that we saw in Q3, Q4 last year will continue into 2022, even with the downdraft, I guess, that we're getting from the large cap markets. One of the other things, Anna, that people should also realize is that although we're obviously extremely well known for our support for the cannabis industry, we only listed 18 new cannabis issuers last year. The leading sectors, it was a tie, 62 each from the mining and from the technology space. And the mining, I think, is going to work well into the year, because precious metals are obviously still strong, and I think people do accept the whole battery metal thesis, whether it's nickel, cobalt, copper, lithium, graphite, and the rare earth metals. That's continuing to attract investment support as well. So we've got all of that, those tailwinds that are pushing the exchange. At the same time, we're working to revamp our listing rules for the first time in a material way in 20 years, basically. And I guess the headline there is that we will be creating a senior tier for the exchange. So roughly 100 or so companies, more mature operating companies with revenues and earnings and so on, will be regulated on the same basis as companies that are listed on Canada's big board. and they will receive some benefits which are commensurate for that, which I won't go into. It's kind of inside securities industry baseball. But suffice to say, it will reduce their cost of capital and increase the breadth of their shareholding or shareholder interest. So all good. We're also doing some things on the trading side to help zero commission brokers that are struggling with fees. So we'll be introducing another trading book. Again, pretty deep inside baseball for regular investors, but again, it should improve the liquidity profile that our companies enjoy, and also should increase access to company shares for investors as well. Lots else going on. Obviously, we'll continue to put our mark on the social media world with events such as this, and get well soon, Bruce, too, by the way. We've learned a tremendous amount, and congratulations, obviously, to you and James and the rest of the team who have done a magnificent job representing the organization and doing some really neat things to help promote our companies and the exchange as well.
Absolutely. Richard, thank you so much for joining me today. It's always such a pleasure to chat with you. I'm hopeful that I get to see you more in person this year, and we can get out of our houses and get on planes and get back out in front of people. Thank you again. Have a wonderful weekend. I don't think I'll be seeing you next Friday. I'll hopefully be seeing Bruce. But if anyone has any questions about anything going on at the CSE, always feel free to give us a call. We're happy to chat. Thank you, Richard.
Thanks, Anna. A real pleasure.